Picture this. A young man, fresh out of college, gets his first paycheck and decides to invest it all in the stock market. His heart is pounding with excitement and a touch of fear as he takes his first steps into the world of investment. He's heard stories of people making fortunes overnight, and he's eager to try his luck. This young man, full of dreams and ambitions, believes he's found the perfect opportunity. A small tech startup, a company on the cusp of a breakthrough, or so he thinks. He throws caution to the wind, ignores the advice to diversify his portfolio, and invests his entire savings, every last penny, into this single company's stocks. Days turn into weeks, weeks into months. The initial thrill of investment gives way to a nerve-wracking roller coaster ride of highs and lows. But he holds on, convinced that his patience will pay off. After all, isn't that what all the successful investors say? Buy and hold, they preach, and the rewards will come. And then, one fateful day, it happens. The company he put all his faith and money into files for bankruptcy. The stock value plummets, and with it, his investment. His hard-earned savings, the fruit of countless hours of work, gone in the blink of an eye. His dreams of a quick fortune shattered. This young man was me. I was that overconfident new investor who thought he had it all figured out. That unfortunate investment was my first venture into the stock market, my first real-world lesson about the inherent risks of investing. It was a harsh, bitter pill to swallow, but it was also a powerful wake-up call. And that, my friends, was my first taste of the bitter reality of investment. But I learned, adapted, and now I'm here to share my wisdom with you. Because in the world of investing, experience is the best teacher. And sometimes, the most valuable lessons are the ones we learn the hard way. So you might ask, what is investing exactly? Well, let's break it down into simple terms. Investing is essentially about putting your money to work for you. It's a way of setting your cash into motion and generating more out of it instead of letting it sit idle in a regular savings account. Now, there are various ways to invest. You might have heard of stocks, bonds, mutual funds, and ETFs. Stocks give you a claim on part of a company's assets and earnings. When you buy a company's stock, you're buying a piece of that company, making you a shareholder. Bonds, on the other hand, are like loans you give to the government or a corporation. They promise to pay you back with interest after a certain period. Mutual funds pool money from many investors to purchase a broad range of stocks, bonds, or other securities. It's like a basket filled with different types of investments. Then we have ETFs, or exchange-traded funds. They're similar to mutual funds, but are traded on stock exchanges, much like individual stocks. Now, here's something crucial to remember. It's always important to diversify your investments. Don't put all your eggs in one basket, as they say. Diversification allows you to spread the risk across various types of investments. But before you dive in, do your homework. Thorough research is absolutely necessary. Understand what you're investing in, the potential returns, and the risks involved. Speaking of risks, let's touch on the concept of risk and reward. High-risk investments can lead to high returns, but they can also lead to significant losses. It's a balancing act. You have to assess your own risk tolerance and make decisions accordingly. In the end, it's not about getting rich overnight. It's about strategically growing your wealth over time. It's about making informed decisions and being patient. It's about understanding that the market will have its ups and downs, but in the long run, investing is one of the most effective ways to build wealth. Remember, investing isn't just about making quick money, it's about strategically growing your wealth over time. Now that we've covered the basics, let's summarize the key points we've discussed. The world of investments can seem like a labyrinth at first glance, but once we shed light on the main principles, it's more akin to a well-marked trail. Diversification, for instance, is one of the cardinal rules. It's akin to not putting all your eggs in one basket. By spreading your investments across different asset classes, sectors, and markets, you safeguard yourself against volatility in any one area. Then we've got the importance of research. Think of it as your compass in this investment journey. It's the tool that leads you to informed decisions. Understand the businesses you invest in, follow market trends, and keep an eye on the economic climate. It's not about predicting the future, but rather about making educated guesses. Next up, we've discussed the risk-reward balance. It's a delicate scale, really. High potential returns often come with higher risk. So, it's crucial to assess your risk tolerance and align your investment strategies accordingly. It's like choosing between a rocky mountain path with a breathtaking view and a serene valley trail. Both have their merits and pitfalls. And let's not forget the concept of long-term investment strategies. Rome wasn't built in a day, and neither is a robust investment portfolio. It's about patience, persistence, and perseverance. The market will have its ups and downs, but remember, it's the long game that counts. Learning from mistakes is another key takeaway. It's not about avoiding mistakes, but about transforming them into stepping stones. Each misstep is a lesson leading you to a wiser investment decision in the future. Lastly, but most importantly, is the continuous education. The investment landscape is ever evolving, and staying updated is the key to stay ahead. Investing can seem intimidating at first, but with knowledge and a bit of courage, it can become an exciting journey towards financial independence. Remember, every investor starts somewhere, and today you've taken your first step.